Okay, hi again, everyone. Thanks again for coming back after your break. So in this part of the presentation, I'm just giving an update on what we see in the global macro outlook. And today's event, we're kind of focused on some of the opportunities we're seeing in Asia. And I think this session is kind of helped to put things in perspective of how we see the global trends and what it implies for Asia. And in particular, there's a couple of themes we've been highlighting all year. One about the sort of near-term cyclical trends that we think is looking good, and we like what we're seeing for the coming year. But there's also a bigger, longer-term sort of decade-out outlook in which we think things have improved and we think is being underappreciated in the markets. So let me get into it. As a summary, when it comes to the macro outlook in this year, we see that the economic expansion is continuing. And we think this is a big deal. When we were here at this point last year, I think many of you were attending as well. And at that point, the vast majority of the world's economists were expecting that we would be in recession by now. And the fact is we've been surprised by the resilience of the global economy, and in particular the US economy. And at the same time, the inflationary trends have improved potentially slowly, but really kind of steadily improving. And we're left with a macro world that I think is far ahead of what we were thinking at this point last year. Then when it comes to markets, in this type of backdrop that we're seeing this expansion, inflation maybe not coming down quickly, but it is moderating. We're really left with a lot of investment opportunities. And as I look at asset classes, I think this is a year where almost all the major asset classes we're looking at, we expect to perform this year. And in particular, the big ones of global equities, global fixed income, I see good opportunities. And then on a longer term perspective, we have out a higher for longer paper that's available to anyone who wants to go to our websites and so forth. But I think this theme has been addressed by many investors. You've probably seen many write-ups. But if I notice a difference, many are focusing on sort of the negative aspects of having higher interest rates that are probably going to be here for a while and higher inflation that's going to be here for a while. And while I think that does add complexities to how we go about investing, I think a lot of people are underestimating this implication of this world that has become more normal. This is a world that's closer to the 90s and the 2000s and less like this past decade we just had of the 2010s. And quite honestly, if you have the economic vitality and vibrance to be able to survive these higher interest rates, that says a lot for the underlying economy. It was just a year and a half ago where 70% of the world's global bonds had negative yields. And, as an economist, I wasn't necessarily panicking, but I didn't think that was good. And the fact is, I look around the world now and I see a much more normal backdrop. As a matter of fact, I would say this is the most normal backdrop I've seen since 2008 of that global financial crisis. We're no longer in a world where the economy has to be propped up by 0% interest rates and perpetual money printing and abnormal policies to keep things going. As a matter of fact, policies are kind of quite fiercely a challenge to get over, and yet companies are getting excellent profits and the economies are chugging along. And so while I think many are concerned about this higher for longer, and I do think we have to be a little bit more conscious of how we do our investing, I wouldn't lose sight of that positive trend we're getting. As we think of the economic cycle, as I mentioned, the way we analyze economic data, we see a continued expansion, and I would say a recession within the next 6 to 12 months does not look consistent with the economic trends we see. You don't have this level of hiring. You don't have this level of expansion and trajectory of some of these leading indicators, and then get into a recession in a very short period of time. We use tools like clocks and wave diagrams. And as we think back over the last couple of years, you can see that we had our recession in COVID, we had our recovery. At the end of 2022, there was a lot of indications that manufacturing was slowing down, the yield curves were inverted, and a lot of the tools economists use to predict a recession was starting to point down. And so when we met at this point last year, we did highlight these are the indicators that are giving us warning signs. But we highlighted last year that there was one big inconsistency, that if you polled businesses, particularly in the US, but really in many parts of the world, what they were reporting is that services were picking up after this COVID environment, and that services make up 80% of the developed world economies, and that they had significant hiring plans. They were understaffed and they continued to hire. And therefore, as we talked about the recession risk last year, we pointed to it's fair to be concerned about that trajectory in manufacturing and all, but the path that services were on did not look recessionary. And I think in the end, that's kind of what was borne out, that when in a world where more and more people are getting employed, and more people are getting larger wage increases than they had for a decade, then that creates a consumption base that's good for the developed markets and for global markets. And as I mentioned, there we are now. At some point, things should slow down, but we're not seeing it in the near-term trajectory. And I wouldn't be too close-minded that this might end up lasting several more years. And therefore, as we invest now, I don't think everyone should be necessarily that negative that a downturn is on the brink. So that leaves us with a macro outlook view. We're overweight growth assets. We like equities, and we're underweight cash. I think in 2023, it turned out that actually almost all the asset classes I tracked ended up beating cash. And that was surprising because cash rates were higher than we had seen in a decade, and yet still everything was beating it. And I'd say by the end of the year, I would still expect most asset classes to beat cash again this year. Within equities, we've been focusing on sort of Japan and Asia as some of our key overweights. The US is a good base. There's so many good companies there. It's kind of hard to ever get too down on the US. We're underweight Europe, but Europe's making an all-time high too. And I think just broadly, there's just a lot of growth stories in many parts of the world. And where I see investments being run is I see a lot of rotation to wherever the opportunity is and whatever's been underperforming. And, so we have our overweights, but there's a lot that's doing well. And then within fixed income, we just have some key themes where we're overweight credits, we're underweight government bonds, and globally, we like Asia credits as having some of the best opportunities. We're neutral on duration, not necessarily overly negative or positive on extending duration. So let me get to the heart of the story here. So firstly, just when it comes to economic growth, the fact is consensus of global economists now see continued growth for the next couple of years. And quite honestly, as I track this data, quarter after quarter, these numbers keep going up. Those who had very weak forecasts keep revising up as they keep getting surprised at the durability of this expansion. And it's still fairly broad-based. And then more importantly, I always say, we don't invest in GDP, we don't invest in economies, we always invest in corporates. And there, I think the story is even better. As we go through results season after results season, for the most part, I think investors keep getting encouraged by what they're seeing. And so on this, a lot of numbers as we analyze the equity markets around the world, but I'd say just focus on the left-hand side where we look at the earnings growth as we're seeing it in the major regions. And I'd say my simple takeaway is I just see double-digit earnings growth all over the world. I see it not only this year, but next year. And that's a good backdrop for investing. And if I see double-digit earnings growth, I think that gives us a good chance of getting double-digit market growth in these regions. And then I think there's several ways that investors are still underestimating what's going on. So one, I highlight that, if you speak to consumers around the world, they're still very conscious about inflation and that we're on the brink of a recession. But as an economist, I'd say, this inflation problem is looking better, and it's a matter of time before people start to feel it. The recession is not that imminent. It's a matter of time before people start to feel it. And the reality is they have more jobs and higher wage growth than they've had in a long time. And you're starting to get spikes like this. Oh, am I standing in front of it here? Spikes like this at the end of the graph where confidence among consumers is starting to leap more than we've seen. And I think that's a natural extrapolation of having this better environment. And if that kicks in, then I think that leads us to potential of having, sustained consumer-led expansion. One of the big negatives over the last year has been manufacturing. Manufacturing has essentially been in a recession. And I think that's a fallout of COVID. In the midst of COVID, we bought lots of goods as we stayed home. And then when we opened up, we went to restaurants and traveled, and we focused less on buying goods. And manufacturing, their inventories went up, they start producing. Manufacturing was in a recession. But if you track the trajectory of what's going on around the world, that looks like it's improving. It's not quite solidly in expansion mode now, but it looks like on the brink of it. And so that's not only like a US story, as in fact, it's a global story. As a matter of fact, I think the manufacturing indicators in Asia, I think, are looking the strongest. And I like that for Asia. Today's conference will be talking a lot about Asia, but we see that manufacturing pickup is almost always good for Asia. Global trade picking up and turning positive is almost always good for Asia. And I think throughout the course of today, we'll be talking about the opportunities. But if I have a strong developed market consumer and I have global manufacturing picking up, then I like to explore these Asian opportunities all the more. Inflation is still, I guess, highly debated. I like to look just a simple chart like this. This is a few different lines of what the US Fed focuses on. So in particular, the orange line is what they call the core inflation, core PCE inflation. And I would argue a lot of progress has been made. It fell to roughly, and if you look at this gray bar, that's the 2% target. And essentially on a 6-month annualized basis, it was essentially hitting there at the beginning of the year. It picked up a little bit at the start of the year, and I think that's left economists a little worried about what does this imply. But quite honestly, if you look at January and the start of last year and other periods, there usually is a start of the year effect where things get repriced a bit more at the start of the year. And so as we're looking at the underlying trends, we see, three big things we focus on. We look at wages, we look at rents and housing, and we look at cars. And if you explain those three, you explain something like 80% of the inflation trends. And so I have a chart here. I think that the trend on wages is good. I mentioned before, I think it's great that many consumers in the world are getting higher wage growth than they've gotten in a long time. But we don't want it to be too hot, too strong. And I think it's moderating now to kind of a period to like what we had in the 2000s and 90s. We don't have to get all the way down to this sort of deflationary decade, but we're at a level that's getting kind of more reasonable. And so if wages are going in the right direction, and these are a couple complicated charts on housing, but on the left one is just tracking new rents. And really, if you average out the various methods and indices that we can track, essentially rent growth looks like it's essentially zero, and it's a matter of time before that flows through into the CPI numbers. And if you look at sort of just the state of the housing market, vacancies have been tracking up, completions have been quite high, household formations lower, and I just look at all of that and I don't really see something that looks like it should be out of control inflation. As a matter of fact, it looks like it should keep coming down with time. And so those are a couple of the biggest aspects of inflation. The other one being cars. I just simply say car prices have been decreasing every month for the last year, and probably maybe doesn't decrease as much, but it's certainly not hasn't been increasing. So then this is a bit of a complicated slide, but really the comments on inflation, the bottom line question everyone has is, what does this imply for interest rates? And so our view is we still think there's a good chance of having a couple interest rate cuts this year. The way we think of it is this would be a Taylor rule calculation, right? And so simply put, this is something that the Fed has articulated as been sort of a guiding framework for them. And so in particular, if you put in where core inflation is, where unemployment is, and you make an assumption on what the Fed will be assuming in terms of a long-term neutral rate, then you get a guide on how they were thinking, what is the right level of interest rates. Powell has said many times he does think they're at a very restrictive level, and as inflation comes down, they don't need quite as restricted a level. So then the million-dollar question is, well, what is that number going to be? And long story short, as we do all this, we tend to focus on this blue box here as being kind of likely numbers. And I would say, fairly using conservative assumptions, I think the number is probably about 4.7, looks like the right number to me. Obviously, there's uncertainties around there. But that implication, meaning the effective rate right now is about 5.3, so it implies a couple of interest rate cuts before the Fed gets to what it probably needs to be. And then as we think about it long term, we make a couple of points. So one, I think the first question I always get asked is, well, how many interest rates are coming? And I say, yeah, I think a couple, but I don't think that's the most important question. Because if you look at the good times for investing in the 90s, like this red circle, or even the 2000s was a pretty good period for investing. When you're investing in those periods, people weren't focused on, how many interest rate cuts are coming, or is the Fed going to print money, or whatever. That comes from our experience of this last decade, right? I think a lot of us are still trapped in that experience of what it was like to invest in the last 10 years. And I was thinking about it. I even look at my team, and some of the fund managers on my team really don't have much experience outside this last decade. But I would tell you, I'm a bit more gray-haired, and I remember investing in the 90s. And in the 90s, what you focused on was, what are the interesting investment opportunities? What are some of the themes that are going on? What is earnings growth? And that becomes a lot more than just how many interest rate cuts you're going to get. And if you were to ask me how to think about this trajectory for the coming years, so I think like this period in 94, I think you get a couple of interest rate cuts, but I don't think you get much more than that. And I think interest rates end up being high until the next downturn comes. And therefore, I would think bigger picture like that, and not necessarily be sort of driven by policies. The only thing is a trigger for buying assets or not. I have a couple more points. I can get really bulled up and enthusiastic. And so when I talk to clients, they highlight that, well, equities just went up 20% last year. They feel like they missed it. And I highlight that, yeah, but what happened was they went down 20% in 22, and they went up 20% in 23. The fact is, we're pretty close to where we were at the end of 2021. I wouldn't be overly fixated on how much you've missed. I would just focus on the investment opportunities before us. A lot of people would say it feels like it's all about AI, and it's all about that Magnificent Seven in the US. And so at a chart like this, maybe it's a bit small, but the gray line here are the granolas. Those are the big stocks, the big market cap stocks in Europe. They've also been performing great. The red line is the top market cap stocks in Europe that begin with S, which just happen to be beating the Magnificent Seven. I also frequently do a chart of the Seven Samurai in Japan. But the fact is, the message I would want to get out is there's a lot of investment themes out there. It's much more than just the Magnificent Seven. Europe's making all-time highs. Japan's making all-time highs. There's a lot of things to tap into. And more than just AI, I keep highlighting the biotech theme. When I talk to clients in Singapore, I highlight that these GLP-1s have been more influential in markets than AI. I highlight that Eli Lilly's stock has gone up more than NVIDIA in the last 2 years. And when I ask my clients, 90% do not know what a GLP-1 is, and the reason why Eli Lilly is up just as much. And I don't mean to, mean that as like to be superior in my knowledge about GLP-1s, but just that I think investors need to know that innovation is out there all over the place. There's so many exciting themes that the markets are getting excited about. Don't be fixated only on the Magnificent Seven. Don't only be fixated on AI. There's a lot of things going on. And then I had just a couple slides. I see my time is running out, but I know many of my clients, they've been influenced by those charts that show markets have always been influenced by quantitative easing. And I always like to invest when quantitative easing is going well and not when quantitative tightening like now is going on. But then I show a chart like this and say, yeah, but the reality is actually what correlates much more with stock markets over the decades is earnings growth. And that's what we have now. And I'd be more focused on that opportunity as opposed to the fact that interest rates are high and we don't have QE anymore. And then I would also say our perspective at UOB, I know fixed deposit rates have been attractive. For the last year or so, many investors can get 4% on fixed deposits, and therefore why bother with other assets? And that's not only a Singapore trend. In the US, they highlight there's roughly $8 trillion in money market funds. And I think people are opening up to this world is more investable. We've just come through a period where 2002 was a nightmare, and 2023, everyone said a recession was coming. But I think there's actually a lot of money on the sidelines. And I think the more these sort of long-term dynamics are appreciated, and the more that these exciting investment themes get out there, I would be aware there's a lot of ammunition on the sidelines. And I think that can give us a sustained expansion. So I'm done with my time. I just have one last point I'd like to highlight. It's that, as an older investor, I'd say, boy, this period really reminds me of the 90s. And so I just highlight some points why I say this to clients. So firstly, obviously the whole AI thing, and I mentioned biotech and this auto revolution on what's going on in automation and connections and so forth, that a lot of these exciting themes remind me of that dot-com era. And I think many people just have the memory that the dot-com era fizzled out at the end, but the fact is it went on years. And I wouldn't be too quick to be looking at AI as a fad or anything like that. Also, I see a consumer-led expansion that's very similar to what I saw in the 90s. I saw productivity picking up then due to the internet, and I think there's a lot of reasons to highlight the productivity gains that we're likely to get from AI. And then maybe and then I mentioned already that the 1994 interest rate period, that was a period where they were hiking rates and then they moderated. That feels a lot like what we're talking about now. We had a fierce interest rate hike period. We expect some moderation, but don't expect too much. It's likely to be somewhat leveled out until you get to the next economic downturn. So I like that period is very similar. And then finally, I give this story of 1996 when the Fed chairman at the time, Greenspan, talked about the irrational exuberance of the stock market. It was a similar period where I know I get this feedback from a lot of investors that are looking at the Magnificent Seven and fearing that it looks a little bit irrationally exuberant. But I do point out that in 96, he said it at the end of 96, but in 97, stock markets went up another 20%. In 98, they went up more. In 99, they went up more. And it wasn't until the second half of 2000 that dot-com started to fizzle out. And from that point in 96, stock markets went on to double from that point over the next 4 years. And so I guess I guess my point being, don't underestimate how these things can have some durability and can last. There are justifications to be cautious about overenthusiasm in the market, but I wouldn't necessarily be too negative. And if the expansion continues, I don't think these things are going to fizzle out that quickly. Okay, so I've used up my time. I hope that gives some perspectives on how we're thinking about investing globally, and I hope gives some backdrop for a lot of our Asian themes that we're going to discuss through the rest of the background. Thank you very much.